Hi, everyone. Thank you for joining today. Just giving everyone a couple of minutes to get logged on and situated before we get started here. But for everyone on the line right now, just to give you a few housekeeping items, the slide deck can be found in the handout section on your webinar toolbar. And please use the question section on the toolbar to ask questions throughout the presentation. We will be holding all questions for the end, and we have 30 minutes allotted for that. We understand that we may not be able to cover all these questions, so we'll be responding via email to those. We are also going to be sharing the slides and the presentation video link following the live presentation. And with that, I will hand it over to Dan Mayo.
Thank you, Allison, and good afternoon, everyone. Thank you for joining us today on our webinar. We're expecting well over 2,000 people today, so we got great attendance here, and thank you for joining. If there are any technology issues, we apologize in advance. The internet is certainly clogged with the amount of activity these days, given what's going on. So we have a great program today. We're going to start with Frank Boudelet, who's going to talk about the business loan assistance, and in particular the Paycheck Protection Program, the forgivable loan program that came into effect with the CARES Act. Then we're going to turn it over to me, and I'm going to discuss some federal tax updates and talk about the recent legislation and some business considerations as well. And then we're going to turn then to Barry Horowitz and Jim Bartek, going to talk about state and local tax updates. And then at the end, we're going to leave a large amount of time, a half hour, for question and answer. So please submit your questions. We're definitely going to read them and try and answer as many as we can at the end of the program. We have allotted a lot of time for that because we realize that this is these are very timely and hot topics, and we know there'll be a lot of questions. So with that, I'll turn it over to Frank, and we can get going. Thank you.
Thank you, Dan. Thank you, everybody, for attending. So I'm going to talk about the business loan assistance programs that are available out there. That's it. Thank you. First thing I want to say is last night around 8 o'clock, the SBA released their interim final rule. This program will encompass those rules. So we're all waiting for the final rule, which we hear is coming out today. Some of the things that were addressed in that 31-page document that we got last night still didn't clarify some of the items, and I still see that some of the banks, some of the law firms and accounting firms are interpreting things inconsistently again. With that, so the SBA has two different programs currently. They have the Economic Injury Disaster Loan Program, which can be used to pay fixed debts, payroll, accounts payable, and other bills that can't be paid because of the disaster impact. That's a grant up to $10,000. And then they have the standard 7A loan program, which had the amendments for the CARES Act, which is now called the Paycheck Protection Program. So next slide, please. Okay, so we'll talk about the EIDL. Next slide. Back one slide, please. So this is eligible for sole proprietors, independent contractors, businesses, cooperative, ESOPs, tribal, small businesses, and business concerns with less than 500 employees, and entities that meet the small business definition. And we'll talk about that in a minute on one of the other slides. You can get a loan for up to $2 million, interest rates 3.75, and a 30-year term. For this loan, they're waiving the credit elsewhere clause, which they typically had in the standard economic injury disaster loan. The SBA can approve based on credit score only without tax returns. Next slide. So we're right now, when you go to their website, you go to sba.gov. You'll see, you go under loans and go to the different loan programs, and halfway down the screen, you'll see a couple of different programs. You have the PPP program, and then you'll have this EIDL emergency advance. You click on that and you'll fill out an application online, and that will ask you a bunch of questions that concern the type of business that you have, foreign ownership. They'll ask you for foreign employees, but you'll have three numbers you need to put in there. Will be your revenue for the last 12 months, your cost of goods sold for the last 12 months, and the number of employees. When you go down a few more pages and after all of their certifications, and there are a lot, you'll be able to put your banking information in, and hopefully within 3 days you will get your $10,000. The next step will be a caseworker will contact you. And then from that point on, I think the process has changed from what it used to be. I have not had any clients that have gotten through and gotten to 10,000 yet. So a few of them have on Monday went in for the loan for the 10,000, and it's a grant, so this won't be paid back. They have not heard back, and it's Friday already. So the 3 days that they were saying isn't seem to be working. Next slide, please. So now we'll talk about the 7A Paycheck Protection Program. Next slide. So the overview here, obviously $349 billion was in potential forgivable loans is going to be advanced to businesses. We did the math, and we don't, based on the number of employees, that's might not cover all the employees that are out there. The loans must be attained before June 30th. And what we're hearing right now from the banks, we heard one bank said we're only accepting loans from our clients because of the know your client rule. So they're not taking anybody else's loan information. We have a couple banks that said, hold off, we're not taking any applications. We even heard last night that banks were saying we're out. We just can't handle this. The SBA hasn't gotten their act together, and everything's happening too fast, and we're not comfortable going forward. So the recommendation is reach out to your bank, make sure they're SBA approved, and find out what they are doing. We're hearing different stories. So some are saying we're going to send you the email, we'll email you the form when it's available, and they're working on getting the form together. So again, these loans are applied through your bank. The process is supposed to open today on April 3rd. I've heard some clients have submitted their pre-application, which is found online as well. And you can also go to withum.com. We have all these forms on our website, and a lot of good information there. So that would be a good place to start looking for some of this information, and then it'll direct you to the other government websites. Independent contractors will be April 10th. They can apply. Okay, and the loan terms are identical for all applicants. Thank you for the next slides. And certifications. This is very important, I think. So one of the certifications you're going to have to sign off on, and on the form, it's a checkbox, is current economic uncertainty makes the loan necessary to support your ongoing operations. So that is one of the criteria that you're going to have to certify that you have been impacted by this virus and this disaster. The funds will be used to retain workers and maintain payroll, to pay mortgage, lease, and utility payments. You have not and will not receive another loan under the same program. And to the extent feasible, you will purchase only American-made equipment and products. And there's other certifications as well, but those are the main ones that are on the form. So again, just make sure when you're signing off on that you can meet those criteria. Next slide, please. So eligible borrowers, who can sign on for this PPP loan? So this is 501c3 nonprofits. I've had a lot of questions on can associations sign up 501(c)(6), and what we see is it's 501c3 is in the actual law. Veteran organizations and tribal business concerns. 500 or fewer employees, including FTEs and PTEs. A part-time employee is considered one employee. Now, businesses that have more than 500 still may be able to apply. It's based on what the SBA determines to be a small business, and that's based on the size standard of the industry, and they have that posted. That's also on our website. So an example, code 33311, machinery manufacturing farm equipment. If they have employees up to 1,250 employees, they would be considered a small business, and they would be able to apply for this loan. So again, if you're in an industry, check out what's considered a small business, because you may be able to still apply if you have more than 500 employees. Also, sole proprietors, independent contractors, and self-employed individuals can apply. Now, there are affiliation rules, and last night they came out and said that they are now looking into the affiliation rules. The issue here was if you had common ownership, and say you were owned by a PE or a venture capital firm, and they owned all these businesses within their portfolio, you add up all of the businesses and add up all those employees. And if they had more than 500, they were excluded from applying for this loan. So now they've been coming under a lot of pressure, because you have a lot of startup businesses that are owned by private equity, and they could use the money, and it's not available to them. They're waiving this also the affiliation rules for Code 72, which is hotel and food services, so restaurants, large chain hotels. And what they're doing, they might have more than 500 employees nationwide, but they're looking at each individual site. So if each site is less than 500, those sites can apply for the loan as well. Next slide, please. So ineligible borrowers. So these are businesses engaged in any illegal activity. So if it's a cannabis industry, you're not going to get any money under this. I'm surprised we had a lot of questions on this. If you have a household employee, no, you cannot apply for this to pay your employee, your household employee or your nanny. Any owner of 20% or more of the equity who is incarcerated or on probation or parole cannot apply. And if you have any other previous SBA loans in the past 7 years and you were delinquent for any reason, they will bar you from applying for this loan. Next slide, please. So what's included? And I think this is still confusing to everybody. So it's employee and it covers compensation up to $100,000 annually and prorated. So basically that means you would calculate any average annual, and we'll see later, it's the average monthly payroll. So wages, commissions, tips, capped at 100,000, vacation, parental, family, medical, or sick leave, severance pay, you have group health insurance, premiums, retirement benefits, that's 401k contributions, and employer, state, and local taxes on the compensation. We believe that's state unemployment. Those would all be considered your payroll costs. For a sole proprietor, the big one that came out last night, independent contractors are not considered for the calculation of payroll costs, which is good. There was a lot of misconception on that and a lot of back and forth. They are not included. They can apply on their own for a loan if they want to do so. So they are not considered an employee, which is good. Sole proprietor and independent contractors up to $100,000. That's wages, commissions, and net earnings from self-employment. So again, those independent contractors would apply for them on their own. It excludes the share of federal taxes and federal withholding taxes. If you're also applying for the sick leave and family leave under the Family's First Coronavirus Response Act, you cannot then get that money as part of your payroll cost. They don't want double dipping. Next slide. So the maximum loan amount, and it's capped at $10 million on the loan, is 2.5 times the average monthly payroll cost, what we just talked about, during the last 12 months before the date on which the loan is made. So we're interpreting that to be from April 1st, 19 to March 31st, 2020. But unfortunately, the back of the instructions on the form says most businesses will use 2019 as their 12-month period. So again, the law is written one way, the instructions has some inconsistencies. And any outstanding loans, any outstanding loans that were made during January 31st, 2020 and April 3rd, like for instance, will be able to be rolled over into this new loan. The advance under the EIDL, that $10,000, does not have to roll over because it's an advance, it's a grant, you don't have to pay that back. Next slide, please. So the loan terms, up to $10 million, and you have the 250% times the average monthly payroll cost. Now again, on an employee that's making over $100,000, you're going to prorate that for the period. So basically, it's going to be $8,333 if their average annually is over $100,000. And again, there's where I say we're not sure what the bank is going to use or accept. Again, call your bank, find out what period they're going to require. If they have a form, get that form. You can start filling that out. But we're not sure exactly what the banks are going to want. You don't have to prove that there's credit elsewhere. That was waived. The interest rate now is going to be 1%. As of Tuesday, it was 0.5%. Last night, or whatever day it is, Thursday. So last night, Thursday, 8 o'clock, they changed it to 1%. It's a 2-year term. The law was up to 10 years. They decided 2 years is long enough. They feel that, you get this excess money. This is the amount that's not forgiven. No collateral is required, and this is 100% guaranteed by the SBA. So they're backing this 100%. There'll be no personal guarantees, and there's no prepayment penalties. So whatever's not forgiven, if you want to pay it back immediately, you may do so. There'll be a 6-month deferral on the payments, but the interest will accrue from the day you get the loan. The interest, accrued interest, will be forgiven if for that portion of the loan that's forgiven. A borrower can obtain EIDL between January 31st and April 3rd, as I said before, and for use for a purpose other than payroll costs. Next slide. So the use of the proceeds. So you can use the payroll costs, rent can be used, that was enforceable for February 15th, utilities, interest on mortgage obligations, and interest on any other debt incurred before February 15th. So those are the uses that you can use the loan for. Next slide, please. So now the forgiveness. This is where everybody wants to know, how does the calculation work for the forgiveness? I mean, you'll be worrying about this after you're trying to have that forgiveness waived. That application is, again, made through the bank. You have 60 days from the time that you get the loan to apply for the forgiveness amount. So it includes all eligible expenses during the 8-week period after the loan is made. And what's eligible to be forgiven is the payroll cost, again, up to the $100,000 per year per employee, prorated for the 2 months. Interest on the mortgages, rent, and utilities. So those all can be forgiven as part of the loan forgiveness. You cannot exceed the principal on the amount of the loan, and the reason that's there is that if you spend more than you got as a loan, there's other factors that come into how much is forgiven, which we're going to talk about in a minute. So anticipate that no more than 25% of the amount forgiven can be used for non-payroll. So again, they believe that because there's going to be limited funds, they want to just give you enough money to cover the salaries, rent, interest, and utilities, and any other operating expenses, you're kind of on your own. So they'll give you up to 25% more than the payroll, but they won't forgive any more than that. The amount is tax-free to the borrower. So the amount that's forgiven will be tax-free to the borrower. When they have that forgiveness piece, the amount of the forgiveness is reduced if there are certain headcount or wage reductions, which we're going to talk about in a minute. The borrower will need to document the number of FTEs and pay rates. So again, let's go to the next slide, please, and we'll talk about why that's important. So what happens here on this calculation is what they really want, and they're trying to do, is to ensure that the employees you had before February 15th, before this disaster occurred, you maintain those employees. If you have reduced the number of employees during the 8 weeks after you get the loan, you will have that portion will not be forgiven. So for instance, if you had 10 employees on February 15th, or the average number was 10 prior to getting the loan, and during this 8-week period, you have 8 employees, 20% of the amount forgiven, of the amount that you spent, will not be forgiven. And that's why that amount, they're saying that the amount cannot exceed, your cost cannot exceed the loan, because if you got a $250,000 loan, but you spent $300,000, the 20% reduction will be on the lesser of the two, which will be the 250, not the 300. So you'll take 20% of 250, and 50,000 of the loan will not be forgiven. So that's for the number of employees, and they count full FTEs. Where we believe the FTEs, it's 30 hours. So if you have 2 part-timers that are 15 hours each, that'll be considered 1 FTE. The reduction is also based on the wage reduction. So here, if you are reducing somebody's salary by more than 25%, the amount that exceeds 25% will not be forgiven. They're excluding employees over $100,000 that you used in the amount that you received, because they believe that if you make over $100,000, they're not really concerned about you reducing that person's salary. So again, what we think would be done here, or what they're thinking would be done, is that once you get the loan, you will quickly hire back all of the employees that you either furloughed or downsized, and you'll hire them back at the salary they had before the disaster, because the government's paying you for that. So that is what the whole purpose of this is to bring everybody back to work. Even though they're staying at home, you're paying them a salary, and actually the government's giving it to them. So it's almost like unemployment. And again, you have to do that by the end of June. June 30th would be the date you have to restore everybody's salary for them to count. a couple of, thank you, state and local. So next slide, please. So there's this couple, I'm gonna run through these very quick because we have a big agenda and I wanna get to questions later. New York City has a grant program and they have small business continuity loan fund. The website on here, you can click on that. If you're in New York City, have less than 5 employees, you can get the grant. Less than 100, you can get the loan. Next slide. Philadelphia has it. I kind of put the major cities where our offices are located. We're assuming our clients are around the same areas. So Philadelphia has a couple of grants and then a loan. Again, you click on the website. Some of this might have changed in the last few days. This section was updated on Friday, and I think there might be a few changes here for this section. Next slide, Florida. So Florida has a disaster program down there for the bridge loan. I would recommend, if you're in these locales, to log on to your local state and city and find out what's available to you. Next slide. You have Los Angeles. Again, there's some, they can get up to $20,000 an interest-free loan for a year, or 3 to 5% over 5 years. No loan fees. Again, website there. Next slide. San Francisco. They're giving grants up to $10,000 for businesses between 1 and 5 employees. They really feel the smaller businesses are really going to be impacted by this. They had to close down, so they want to get some money in some of their hands. Next slide is the New Jersey Economic Development Authority, which is here in New Jersey, where I sit. And here, there's the EDA is giving out some money, up to $5,000 grants. They also have a loan program. I think this just came up on Monday or Tuesday. They put this online. Next slide. You have some more reserve funds and emergency guaranteed monies that you can get. So if you are in New Jersey, I would log on to that website and see what's available for you there. Next slide, please. And I apologize for going really fast, but I know we have a large agenda, and then I'm sure there's gonna be a lot of questions that I did not answer. So the things that I would do if I'm sitting there today, I would have already contacted my bank, and I would find out, number one, are they an SBA lender? And if they are not, I would try to find an SBA lender. You can call us here at Withum. We work with a lot of banks and lenders, and we can help direct you to an SBA lender. The application is a 3-page application from the SBA. We're not sure exactly what all the banks are going to want. They may have their own forms that they want you to fill out and complete. The information that we're requesting, because we're helping with some of the calculations, we need payroll records from 2019 to 2020 monthly. The banks are probably going to require financial statements at some point. Up front, they may not when they take the initial application, but again, they may require some of this information. I would gather that information just in case. Personal financial statements, tax returns for the last 3 years, schedule of all debt, mortgages, accounts payable, and proof of payments. Again, they are going to look at this application and determine whether or not you're going to get the amount that you are applying for. We did hear last night, one of our partners up in our Boston office contacted me that one of his clients was told that the max he's going to get is $1 million, even though his application was for much more than $1 million. I've had other partners tell me that they talked to their bank, and the bank said, look, you had a profit last year of like $2 million. We don't think that you're going to qualify for this loan, even though their revenue was down 20% because of this. So we're not sure what's going to happen with this whole process. It's up in the air still. As of this morning, they were supposed to be taking applications, and like I said, we're hearing that banks are saying we're waiting for the final rule to come out before we move, because we've been changing our internal processes so much over the last week that we just can't handle the onslaught. So with that, I'm going to look at some of the questions that we're asking at the end. I will try to answer those questions. So I will now turn it over to Dan.
Great, thanks, Frank. Thank you. So I want to thank you for that great presentation. It's very interesting and informative. And I do want to caution people, things are moving very fast in this area. I know I also am getting at least 20 calls a day on the PPP. And what you heard a week ago is not the same what's going on today. Even yesterday, as you said, the document came out last night, the interim final rules from the SBA. Things are moving very quickly and interpretations are changing. And so if someone, you got advice 3 days ago, you may get a different answer today. And it's not necessarily they were wrong, when they gave you the advice. It's just that things are moving so fast, interpretations are changing, even within the SBA and changing from the statute. So it's a quick moving target, and I know it's hard and frustrating when people are trying to get loans to keep their businesses afloat. But please understand that the guidance is coming out faster than it can be processed. And a lot of people are reading articles online that might be written 3 days ago, and unfortunately those are even out of date. So make sure you're getting the latest, greatest, and check the dates of the articles. Okay, so now we're going to turn to some tax issues and talk about some federal tax issues before we turn to the state and local ones. Everyone by now should probably have heard at some point there's been an extension to the April 15th deadline. I put the history here on the slides just to give you a sense of that it's gone back and forth. And this is another one of those things where there's old information on the internet. And when I say old, I mean within 2 weeks. Things have been moving very quickly on the tax and on the SBA side. And so you really need to check the dates of any information you're getting to make sure it's the latest that's out there. So here there's a bit of a flip-flop, but from the 17th to the 20th, it was unclear if it was a filing and a payment extension or just a payment extension. Treasury said one thing, IRS said another, and then Treasury went back and said, no, we meant what we said. So then when we go to the next slide, we see that on March 20th, the IRS corrected themselves and they issued a new notice, 2020-18. And so that's the latest, greatest on the fact that there's a filing and payment extension, which we'll talk about in a second. The IRS also issued 24 Q&As relating to the notice, and then a couple days later, they expanded it to cover the gift taxes and the generation skipping tax filings. So the upshot of all this is that the extension applies to certain payments that are due April 15th, the 3-month automatic extension. No paper filing is required to take advantage of the extension. And so now we'll talk about who it applies to. And to give you a sense, what on the next few slides, I tried to incorporate all the guidance and organize it so that we're not going to go by by document and say this document said this one corrected it. I'm going to try and incorporate it all. So on the taxpayer side, it applies to all taxpayers who have a return due on that time period and so for certain taxes. And importantly, the IRS came out and said the taxpayers do not need to be sick or otherwise affected or quarantined as a result of COVID-19 in order to take advantage of the notice. On the tax exempt side, it does apply to the Form 99T that's filed because that's a tax return, but it does not apply I know a lot of hospitals and universities and other tax exempts file Form 990, and that's just an information return. So there's no extension for the Form 990s. Turning to the next slide, we see that on the timing and types of payments, it applies to the first 2 bullets are really the heart of this. It applies to federal income tax payments, including self-employment, that are due April 15th. And there's on the income tax side, there's 2. It applies to 2019 income taxes that are due April 15th and 2020 estimated income tax payments that are due April 15th. So that's the first quarter 2020 estimated income tax. It does not apply to the second quarter estimated income tax, which I have on a later bullet, but the second quarter is going to be due June 15th, even though the first quarter can be deferred until July 15th. So that is a little bit of a quirk there, something to put on your calendars, because that second quarter estimate will be due before the first quarter. It also applies, as I mentioned, they had issued a separate notice saying that the extension applies to the federal gift and generation skipping tax payments that are due on April 15th. And so this is also no extension needs to be filed. It's an automatic filing and payment extension. So what they said was, if a taxpayer, normally when a taxpayer files an extension, if they're required to file an extension, it's an automatic 6-month extension. But here, because they granted an automatic extension to July 15th, they said that if a taxpayer does file an extension to get more time, they're not going to get 6 months. They're only going to get 3 additional months. So it'll bring them to July 15th, which would have been the normal filing time had an extension been filed by April 15th in the ordinary course. So the long and short of it is no extension is necessary by April 15th. Payment does not need to be made until July 15th. And if an extension is filed by July 15th, it extends to October 15th. It applies to original returns that, we can go back, please. Yeah, it applies to original returns that were due in 2019. So like a fiscal year taxpayer that ended in 2019, but they had previously filed an extension to April 15th. they'll get the benefit of this extension as well. And they get sort of a second free extension here to July 15th of 2020. So the next slide, please. On the type of tax we talked about, it applies to income tax, the 2019 income and 2020 first quarter estimate, and it applies to gift and generation skipping taxes only. The IRS did come out with a helpful statement, which was sort of unexpected, that in the Q&A that said Section 965, these repatriation installment payments, if they're due April 15th, the IRS, and the BEAT as well, if the IRS said that those are also extended under the notice, which was something, again, unexpected, so that's why we want to highlight that here. So what does the extension not apply to? It does not apply to the payroll taxes, the excise taxes, or to estate taxes. There is a separate partial payroll tax deferral we'll talk about a little bit later for employers. But in general, this extension here for individuals and corporations that are due April 15th, no payroll extension, excise, or estate tax, only income, as we mentioned, and gift. On the miscellaneous side, in addition to the deadline extension, they also extended a couple deadlines to make contributions to an IRA or HSA. So these are tax-favored contributions that usually were needed to be made by April 15th, but because they extended the return, they're extending the date for these contributions as well. And there's some other special rules there in the notice in this Q&A, as I mentioned. If you were looking for IRA or workplace-based retirement account rules, there are some other favorable rules. On the next slide, we see that the extension helps people who owe money, but it does not apply to refunds. So the typical rules apply. The sooner you file for the refund, the sooner you'll get the refund. So if a taxpayer is looking for a refund from the 2016 year, for example, they realize they made a mistake, they need to amend, or they want to do some, want to amend that return, they need to file that by April 15th. There's no extension for that. Also, if corporations want to make an overpayment application on Form 4466, they also need to file that by April 15th, 2020. We mentioned here that those applications for overpayments are based on an estimate of the tax liability that the taxpayer places on the form. And so that estimate, there can be tax planning undertaken to help reduce that estimate and therefore increase the size of the overpayment, which would help bring money into companies quickly, which is the goal of the extension. So there are planning ideas. We mentioned a few here. There certainly are others, but it depends on the profile of the taxpayer. And so keep that in mind when filing those overpayments, that there are automatic accounting method changes that can be made to reduce taxable income and therefore get a larger refund of an overpayment of estimated tax. Also on the state and local side, there are many ways to bring in money quicker. Again, we just mentioned it here in that anytime there's a federal refund, you always need to consider state and local taxes, indirect taxes, particularly in this time when companies need money and they need money fast. And so the goal with a lot of this tax planning is not so much long-term planning, it's short-term liquidity planning. And so that's something we're actively engaged in for clients. So on the next slide, we're going to talk, we're going to switch a little bit now to legislative developments. And so there's been three phases of legislation that came out, ending with the CARES Act. We're going to start here with phase one. And this was the first piece that was passed on March 6th. And the one thing I want to highlight here that is loan subsidies were provided in this initial legislation. And so it's designed by putting $1 billion in loan subsidies into the legislation. They were hoping the SBA would leverage that into $7 billion of loans. Obviously that proved to be not a drop in the bucket compared to what was needed, which is why we have later legislation. But on March 13th, the president also declared a national emergency, and there's an emergency declaration under the Stafford Act and a disaster designation under the Stafford Act. And these are the designations that allow the Treasury Secretary to make certain actions, like extending the deadline, the 4/15 deadline. The Treasury Secretary is granted that authority as long as the president declares a national emergency or disaster, which was done here. So we turn now on the next slide to the phase two legislation, and this was passed on March 18th. This is the FFCRA, or Families First Coronavirus Response Act. This is the most important provision of this, and where we get all the questions come from the business community, is this paid sick leave and family leave with the refundable payroll tax credits, up to a cap. And this is where we're seeing a lot of questions There are other things, but you're right, there's a decrease the unemployment insurance, they extended the number of weeks from 26 to 39, increased Medicare funding, a lot of other great stuff. But on the sick leave and the family leave, it requires small and medium-sized employers under 500 employees to provide sick leave and family leave that's funded by the federal government up to a cap. And so the thought here was they were trying to equalize the treatment of small businesses with large businesses who already provide those types of benefits. So the businesses that provide them have to provide 2 weeks of sick leave, and the employee has the option to substitute paid leave if the company provides it. But after that 2 weeks of sick leave, then family leave kicks in for 10 more weeks. There are specific requirements, though, in order to obtain the leave, and it has to be keyed to the employee's health or to the need to care for someone else relating to COVID-19. And depending, there's a list of 6 items, and depending on which of the 6 items is the reason for the leave, determines how much is required to be paid. And so if it relates to the individual being sick themselves, it allows up to $500 a day, $511 a day, I think. And if it relates to caring for others, it's a reduced benefit of $200 a day. But the way this works is the employer pays the employee, and then the employer, the way they get their money back is they stop some of their deposits on the employment taxes they pay to their other employees. So if they pay sick leave of called $2,000, but they owe $8,000 of employment taxes for the quarter, they would just pay 6 since they paid 2 in benefits. So the refund to the employer is designed to come on an expedited basis through that reduction in the deposits of the payroll tax. In the event that the sick leave is larger than the employment taxes, so for example, you have one person on sick leave, one employee on sick leave, and only one other employee, in that case, the sick leave is likely to exceed the payroll taxes. Then you have a situation where the IRS came out with a Form 7200 that allows taxpayers to apply for a refund, a quick refund, or even an advance payment in some cases under that new Form 7200. I got to give the IRS credit. This is one case where they came out with a form one day as draft and finalized it the next day. They've issued a tremendous amount of relief, and so has the Labor Department in response to this. On the bottom here, we see there's an IRS website dedicated to COVID-19 that lists all the guidance, and if you really want to see everything in one place, it's there on that IRS website. If you type in IRS coronavirus website, it brings it right up. And also I put links in all these slides, and Frank did as well in his. And so anytime we see your web page here, that's a link. So if it doesn't click on the first time, hit Control. Sometimes it'll activate the link. And so I tried to link as many things as we could so you could just bring you right to the document when looking at the slides. I know it's often helpful, and it makes it easier to find these things. On the Labor Department side, they issued Q&As, a lot of documents which are again provided on that prior slide. So we're going to skip through this paid sick leave and family leave provisions since we discussed them, and I know we want to leave a lot of time for Q&A. So if you can advance it, there we go. Thank you. So we're going to talk now about the CARES Act, and which is the phase 3 legislation. And this is the one that was passed March 27th. This is the legislation that brought in the PPP, the Paycheck Protection Program, and this is the sort of 2.2 or 2.3 trillion dollar legislation that is attempting to ease the burden on employees and businesses as the economy is shut down in response to this global pandemic. And so there's also been in that legislation, the CARES Act, they passed a lot of tax provisions on the corporate side and on the individual side. And so we're going to run through a bunch of those provisions. To summarize it, though, all of these provisions are designed to put money in people's hands as fast as possible. And so if you keep that in mind, you'll see a lot of this stuff will make sense. These aren't so much giveaways as they are ways to quickly make the elections or decisions that will almost immediately try and put money in people's hands, businesses' hands to pay their employees, and in employees' hands to to buy food and pay for their expenses, given that the economy is shut down. So the first one is this employee retention credit, and this one and the next one, the employee payroll tax deferral. These two are only available if the taxpayer does not use the forgivable loan program and the PPP. So this applies generally. Usually, you see this when either the employees are making under sub $30,000, for example. Sometimes it's more effective to take this credit than the PPP program, Also, I recently had a client that was a 501c4, and the PPP program only covers 501c3s and I think C19s. So there's some limit to it. Not all nonprofits are covered under the PPP program. So if they're not covered on that program, they then default back into these, and they would take these two benefits and the EIDL, which is the loan that Frank talked about, the economic injury disaster loan that Frank talked about a little bit earlier. So what is this employee retention credit? It's a retention. The employee gets a refundable payroll tax credit, much like the paid sick leave and family leave we talked about. And the credit equals 50% of wages paid from March 13th to the end of the year. Again, this also uses that same Form 7200. And I listed here the other documents that talk about this credit that have come out. And I linked them here for you so you have easy reference to find them and locate them. It applies to employers who meet two criteria. And the first one is that the operations are fully or partially suspended due to a COVID-19 related shutdown order. And so when I talk about this to people, I generally say, I think of the full shutdown as the retail, non-essential retail stores, and the partial shutdown as restaurants who no longer can feature in-room dining, and so they have takeout and they have pickup. And so that restaurants and retail are kind of the prime examples. Other businesses too, that are non-essential were closed, and even ones that are essential are not operating at full capacity, like dental offices, right? Dental practices are seeing it mostly on an emergency basis these days, given that the ease of transmission from the mouth is something that's caused a lot of dental practices to have to partially suspend operations. The second test, it's an OR test, so it is disjunctive, is where there's a substantial decline in gross receipts. And so the payroll tax credit only applies during that decline period. So what they do is that period begins when your receipts drop by gross receipts, so it's top line revenue, drops by more than 50% relative to the same quarter in 2019. And then similarly, that period ends when there is, well, not, yeah, when that period ends when the decline in revenue is less than 20%. So when your revenue picks up back to 80% of the prior quarter from 2019, that's when the period ends and the credits stop becoming available. But it's only during till the end of the year. So if things, I guess they're contemplating a somewhat quick ramp up, although every day that's seeming less and less likely, given that the shutdown orders were recently extended to the end of May in many cases, and you listen to the experts. I happened to listen to Dr. Fauci on the news last night, and the question was posed: even if the shutdown were to end, do you see things going back to normal quickly? And he hedged answering that question as best he could, and wouldn't give a sort of forthright answer because he knows that things are not going to go back quickly. So what he said was something generic, like it's not going to be, it's like the flip of a switch. And they anticipate a gradual easing back in to the way of life as we know it. So this employee retention credit applies regardless of the size of the business or the number of employees. So that's helpful. It does apply to tax exempts, and it applies to qualified wages. And so here, the legislation is a little more favorable to the smaller businesses, because if a company has more than 100 full-time employees, then it applies only to the wages of the employees who are not working as a result of the suspension or the gross receipts declining. And in the case of 100 or fewer employees, those businesses, it applies to all wages for all employees, regardless of whether they're still working or not working. So the credit's a little more expansive for the smaller businesses. The credit is capped, and this is why it's not as favorable for most people. It's capped at the first 10,000 of wages, which includes health benefits. So the credit, if it's a 50% of wages credit, it's a $5,000 maximum credit per employee. And that's where you see the PPP, which allows up to 2 months of 8,300 maximum is the 100,000 employee. You see where the PPP is more generous. This is capped at 5,000 a benefit. So the credit also, as we mentioned, is not available if the loan is obtained under the PPP. That'll be significant. We talk about the next benefits. There's a difference there. And the employers recover this money from the IRS. The way they get it back is the same way with the family and sick leave, is that they reduce their employment and income tax deposits by the amount of the anticipated credits. and the IRS came out with this notice 2020-22, which is surprisingly complex to describe a very simple concept that there won't be penalties. And I think it's just regarding the nuances of withholding, employment withholding tax, sort of a niche in the tax world that some people are very adept at and others know it more generally. But there's a lot of detail on that notice to come up with a simple concept that we won't penalize you if you deduct your employment taxes by the anticipated amount of the credits, as long as you do it in good faith. The U.S. Senate also released, which is surprising, released frequently asked questions. You don't normally see the U.S. Senate Finance Committee issuing guidance after legislation is enacted. I understand they do reports before legislation is enacted, and that's part of the legislative history. But they issued guidance after, and they did caveat at the end. They said it's for informational purposes only and should not be relied on for legal advice. So what do people do? They rely on it for legal advice. In fact, just yesterday I wrote, I cited something from that for a proposition that was somewhat unclear elsewhere, but they made it clear in that document. So the next benefit is the employer payroll tax deferral. And this says employers can defer payment of the employer's share, only the employer's share of Social Security tax, and if you're self-employed, 50% of self-employment taxes. This covers a slightly different period than the employee retention credit above. It's March 27th to the end of the year. Why they picked a different date is anyone's guess. But the deferred amount in this case, it must be paid in equal installments by the end of 21 and the end of 22. So it's somewhat limited deferral, but again, the goal of this is to put cash in businesses' hands so they can use it to pay their bills and pay their employees, more importantly. This applies regardless of the size of the business or the number of employees. And also there's no interest rate imposed on the deferred amounts. I don't know if the IRS will impose one at a later point, but the statute did not impose an interest charge. So if it's an interest-free loan, I would imagine most people are going to take advantage of it. But keep in mind, the money does need to be repaid by the 2021 or 22. So already I've seen questions come from legal counsel saying, well, what if they go bankrupt in 2021 and don't pay it? Is there, is this the type of tax where there's liability on the shareholder, the company, that kind of thing? So there's always unique questions come up. This benefit here is interesting because they say it's not available if the taxpayer has any debt forgiven on a covered loan under the PPP. This is different. The other one, the benefit above the ERC, the employee retention credit, was denied if the taxpayer obtained the loan. Here on the payroll tax deferral, you have to obtain the loan and get some kind of debt forgiveness in order. Practically speaking, though, if a taxpayer obtains a covered loan, the reason they did it was to gain the forgiveness. So in the way this is written, it seems to suggest even $1 of forgiveness forecloses the payroll tax deferrals. They don't want too many benefits going to people at once. One of the consequences of this payroll tax deferral is that the tax deduction will also be deferred. Because the payroll tax is being deferred and not paid under 461, it's just not at the current deduction. So that would be deferred regardless whether you're cash or accrual method. On the net operating loss side of things, two favorable rules came in to help taxpayers. One is that NOLs arising in 2018, 19, and 20 now can be carried back 5 years, so they weren't permitted to be carried back prior. This is nice because if you carry back an 18 NOL to 2013, that's a pre-TCJA year, and the top tax rate at that point was 35%. So this is a very helpful provision. I think it has somewhat limited utility because 2018 and 19, generally speaking, were good years for a lot of businesses. So they probably did not have NOLs. 2020, they will have NOLs most likely, but that won't become apparent until they file in 2021. So that will be helpful then. But in terms of current benefit, there are some taxpayers who can take advantage of this. For some reason, they had losses in 18 or 19. There are many companies that meet that profile. It's just not as broad, I think, as some of the other benefits can be, applicability. Also, the second thing this did was it removed the 80% limit of taxable income limitation. So one of the things the Tax Cuts and Jobs Act did in 2017 was it said that in order to raise money, it said that your losses now, you can still deduct them, but they're limited to 80% of taxable income. So they limited the use of NOLs. And so now they remove the CARES Act removed this 80% limitation to make them more deductible. So now you can go back and amend returns for 18 and 19 and get some of that money back if you were denied use of your NOLs. You couldn't take them in full. This rule does spring back into effect in 2021, so it's a short-term rule intended to sort of get taxpayers through the current crisis. And I'll just highlight in this last bullet here that there's no change for capital losses. The rule remains 3 years back and 5 years forward. On the next slide, we'll continue with the corporate provisions and talk about the excess business losses. And under the it's under 461L. Generally speaking, the excess business losses, what they do is they deny individuals and other and pass-through entities, non-corporate, the use of business losses against non-business income. So you can take your business losses to the extent of your business income plus an additional 250,000 or 500 in the case of joint filers. So what the CARES Act does is it repeals that limitation, the excess business loss limitation. Again, this was a new limitation that came in 2017 as part of the TCJA. So the CARES Act repeals it for years 18, 19, and 20 as if it didn't exist. So again, another chance for taxpayers to amend their prior returns, take advantage of losses and get a refund and hopefully bring in money fast. So this in conjunction with the NOL rules for a lot of people I know in the real estate industry is going to be a big relief. Also, they amended the act, the refunds for AMT or alternative minimum tax credits. And before the CARES Act, there was a corporate alternative minimum tax. And if taxpayers paid that tax, they received a credit going forward, and that could be carried forward several years. And the TCJA repealed the corporate AMT. And what it said was that any credits that were remaining for 18 to 21, they could take 50% of those credits a year were refundable because they know they couldn't be used anymore. So they made them refundable and said the balance is refundable in 2021. And so now the CARES Act changed that and said companies can obtain a refund of their AMTs going back to 2018. They can split it between 18 and 19 or take the whole thing in 18. And so this is great for everybody, but particularly for companies that might have gone out of business in 19 or 20 and that forfeited their, or even 18, forfeited their AMT credits because the way the law was written, the TCJA, you could only take 50% a year until 2021. So if you didn't survive till 2021, there's nothing that allowed the taxpayer to claim the balance of those AMT credits. So now they can go back, file a refund, and collect the refund amount relating to the 2018 and 19 year. There was also a temporary modification to the 163J interest deduction limitation. And so this allows, it increases the limitation so taxpayers can deduct more interest. But there used to be a 30% of adjusted taxable income limitation, increase it to 50%, so to allow more of an interest deduction for 2019 and 2020. There are special rules for partnerships, but in the interest of time, we'll keep moving. So for 2020 businesses going forward, when taxpayers file their 2020 returns next year, the government anticipated they'll have significantly reduced income. So if without that income base, it's harder to take deductions for the interest. So what the government said is you can use your 2019 adjusted taxable income in calculating your limitation for the 2020 year. So it gives them the option to elect to use a higher base, which will allow a greater interest deduction on your 2020 return. And the final corporate tax provision I'll mention before we turn to the individual side is that it fixed the so-called retail glitch for a qualified improvement property, which again, qualified improvement property are improvements to the inside of a non-residential building, so commercial building, after it was placed in service, but it excludes elevators, escalators, and a couple other things. It used under prior law, it was given a 39-year or 40-year, depending if you're using general or ADS depreciation. Now the CARES Act reduces that to 15-year recovery period for general depreciation, and you can also get bonus now. Amend and go take bonus. Or if you're under the ADS, for example, you elected out of 163J. Recall that if you elect out of 163J, the price is you have to slow down your depreciation under ADS. Well, the CARES Act says there's a 20-year depreciation for ADS. So it's helpful. It brought you down from 40 years to 20, so you can double up your depreciation deductions, but it makes you're still ineligible for bonus if you're under the alternative depreciation system. So again, another helpful rule to bring in money relating to qualified improvement property. So turning now on the next slide to the individual tax provisions, the cash rebate, something we've heard a lot about in the press, don't need to really cover it too much here. Checks are coming out in the next probably 2 weeks now, 2 to 3 weeks. Also, they waive on the retirement planning side, or a couple of provisions I'll just breeze through here. They waive the early withdrawal penalty, the 10% penalty if you need to make a distribution from a retirement plan for coronavirus related purposes. There's the provisions I list here on the slides. But the way it works is normally they waive that 10% penalty, but the taxpayer still has to pay tax on the distribution. And what they said was you have an option. You can either spread that tax over a 3-year period, or you can repay the contribution. If you want to just take your distribution, you can pay it back when things recover and your COVID-19 related problems subside. If you want to put that money back in the retirement plan to allow for future tax-free growth or tax-deferred growth, you can recontribute it within that 3-year period without worrying about the contribution limits. So again, a helpful provision. You can use the retirement plan now when you need the money, but also put it back in a couple of years, which is an unusual type provision. They increased the loan limits were increased, and the RMD required minimum distribution rules were temporarily waived. So for 2020, the RMD rules are waived for IRAs and other defined contribution plans that have an RMD. Not all plans like 401ks have an RMD requirement. So on the next slide, we'll turn to on the pension funding. They relaxed some of the rules for companies that fund their pensions. There's this quirky $300 above the line charitable deduction. If you recall, that charitable deductions are only available to taxpayers that itemize. And so for taxpayers that don't itemize, normally they cannot take charitable deductions. So this new CARES Act gave a $300 above the line, meaning you can take it even if you take the standard deduction. So taxpayers can deduct up to $300 in 2020 for certain cash contributions, only cash, to churches and other charities. So a nice deduction for people in 2020, but somewhat limited. There's an increase on the higher end of the charitable deductions, and we'll call the 300 the lower end. On the higher end, where people the contributions are so large, they're bumping against the upper limit. And hopefully there's a lot of those people in these times. I don't know if there are, but hopefully there are. These individuals, they increase the limit for individuals and they increase the limit for corporations. So the limit was suspended in the case of individuals, and in the upper limit, meaning the percentage of adjusted gross income that can be donated without reducing it. And then finally, there's this exclusion for certain payments to employees that if you use it, they use it towards their student loan payments. It can be non-taxable to the employee, which is great because the employer gets a deduction for compensation. The employee does not need to include it into income. What I call the deduction non-inclusion scenario, which I joke is the holy grail of tax planning. Okay, so we'll turn now to a couple business points relating to these tax provisions. And we'll start with the credit facilities. Many companies are in need of cash. They have credit facilities. We've seen clients rushing to draw down on them as fast as possible, and mostly to draw down on them before the bank pulls it. Right, liquidity is the key to staying in business. So they want to draw down the cash to sort of ride out the storm. They're willing to pay additional interest. So some issues to consider with your credit facility. If you think the bank may pull it, you might want to look at the material adverse effect clause in the agreement. It's not a boilerplate clause, so it is different for each business and each lending agreement, and it may have been negotiated when you even signed it. So you need to look for compliance with this clause to make sure that nothing will cause the bank to shut your facility down. And so things we recommend you look for in these material MAE clauses are whether they're forward-looking or backward-looking, right? Backward-looking is obviously going to be helpful. Forward-looking, given the current crisis, is not. Look at the definitions of EBITDA and what's recurring, non-recurring, other things here, just to focus on to make sure that you still have access to the credit facility when you need it. If it's not now, if in a month or two you do need it. Switching on the next slide, we'll talk a little bit about M&A activity. There's been a dramatic decline in M&A activity. You saw recently in the newspapers that Xerox pulled out of its tender offer for HP, Hewlett-Packard. So that's the one public deal that's been announced. But in the middle market scenario, we're seeing a lot of slowdown, dramatic slowdown in the M&A activity. Well, the key questions we get here, a lot of companies, they may have a letter of intent either to buy or sell, and they're saying, what can I get out of it? How do I stop the other side from getting out of it? The answer with the LOIs, it's usually they're non-binding. And again, these are individually negotiated documents. They can be written in a binding manner or a non-binding manner. Usually they're non-binding. So one party, you can expect some renegotiation to occur. If you're the seller, the buyer may come to you looking to modify the deal a bit. Similarly, if you're the buyer, you may want to go to the seller and say, this is not worth what it was a few months ago or even a month ago. So let's talk about revising the deal. If they had signed the deal, it's a different scenario. Now they have a signed legal agreement. The only way out of the deal are two clauses: the MAC clause, the material adverse change clause, or material adverse effect, like the lending agreement, or the force majeure clauses, acts of God, etc. So we're recommending, that you really need to review these clauses, make sure that you're covered. Some are narrower than others, some are broader. They're drafted in a variety of ways, and depending on whether you want to keep the deal, you want to get out of the deal, you want to stop the other party, your interpretation may change in how you look at that agreement. So on the next slide, we look at some employee assistance programs. Section 139 is one of these great programs that allow for this deduction non-inclusion. The employer gets a deduction for payments it makes to individuals that do not have to include it into income. Provided on the bottom there, you see it covers the employee's reasonable and necessary personal, family, living, and funeral expenses incurred as a result of the current, and then you can substitute COVID-19 there. And so that's what 139 will cover. If a company pays them to the employee for those purposes, they're tax-free to the employee, even though the employer gets a deduction. There's a quirk here I put in these slides about whether the emergency versus a disaster. I wrote an article which is on the Withum website that lays this argument out in more detail and why likely the statute likely applies now, even though you have this issue. So it's online if you want to read it. On the next slide, we talk in more detail about 139, what's covered and what's not covered. What's not covered are items that are covered through insurance. So if the employee has an insurance policy, they're covered for something. Take the case of a disaster, their house was knocked down, and the employer says, I'll give you money for a new house. If they have insurance, they're going to get a double recovery. So the law says that's taxable to the employee. It's not covered under 139. Also, income replacement payments like sick pay or lost wages are not covered. And similarly, non-essential luxury or decorative items. It's almost funny that they had to put that in there. It's, the taxpayer says my lamp broke because for some reason, and I want this to be tax-free. That's not covered. What is covered are medical and funeral expenses of the family as a result of COVID-19, child care expenses, and telecommuting costs. These are examples of what is covered. We do recommend that employers have a written policy in effect to explain how the program is administered, how the claims process works, mostly to make sure that it's administered fairly among all the employees. But we do want to point out that this is a very favorable section because they don't require an accountable type plan like you typically see with employer reimbursements. All right, the regulations talk about an accountable plan where the employee has to prove their expenses. That's not required here. So the taxpayers are not required to account to their employer for the expenses. So it's not a big bookkeeping burden, and there's a big tax benefit to the employee, which inures to the employer because there's a lot of goodwill when someone gets tax-free income and extra assistance for these types of items. They're generally very grateful. On the next page, we'll talk generically about some other employee assistance programs. We'll start with employee leave. Employee leave donation programs have been around for years. I put some of the sites there for some of the notices the IRS has issued for past hurricanes and events. And what this does is that an employee can donate their unused leave time to other employees, to the company, and the company allocates it, or you give it to an employee in need, and you donate it to a bank kind of thing, or the employee donates it, gives it back to the employer, and the employer donates an equivalent amount of money to charity. And so the tax implications of the donor and the donee vary depending on the type of the program. The point of the discussion here is just to mention that these types of programs can be adapted to the current situation. So there are things that can be done, again, to help ease the burden of employees who may be suffering related to COVID-19. On the employer loan side, bona fide loans are not taxable from an employer to an employee. What does make them taxable is either they're not bona fide loans, some kind of disguised compensation, or if the interest rate has a below market rate, there's a compensatory element to the loan. So for example, if the interest rates are currently in the 3% rate in the range, prevailing, let's say 5% loan is 3%, and the company says, I'll give you a no interest loan for 5 years. The compensatory element is the difference between the current loan of 3%, the present value of which, and the present value of the other loan, which is going to be the value of the loan, by the way, and then the present value of a loan at 0% interest, and so which would be less than the present value, and then that difference would be the compensatory element. There is a way out of 7872, two ways out that we'll mention here. One is there's an exception. It doesn't apply to if all the loans outstanding between the employer and the employee do not exceed 10,000. So if a company's thinking of loaning, $11, $12, $15,000 to an employee, one way out is just to loan it to them, loan them 10,000 at 0 interest, and you don't have to worry about 7872. Another is just making the interest rate on the loan equal to the AFR, the applicable federal rate. Now, the AFR varies depending on the term of the loan, but I looked up about a week ago, I looked up the 5-year rate, the rate of AFR for a 7872 loan for 5 years, and it's just under 1%. So the rate doesn't have to be very high in order to avoid 7872. Years ago, you would need a 5, 6, 7, 8% rate. The rates are so low these days that it's sub 1%. So it's not very hard to avoid this section. On the next slide, talk about some other issues. Employer provided meals and parking. Meals are taxable to employees when they're working from home. It's not like the de minimis fringe where they have the cafeteria for the employees. On the commuter and parking side, you have these transit passes, et cetera. Employers may want to advise the employees of the right to cancel these programs or suspend them temporarily during the time they're not commuting, so they're not paying for a use it or lose it type benefit. And on the health insurance side, the IRS came out with this notice helping to make sure that any certain changes to HD, high deductible health plans, would not ruin a taxpayer's ability to contribute to an HSA, health savings account, which is the reason why they take out these high deductible plans in the first place. So that's helpful guidance that came out early in this disaster. On the next slide, I think, is the final issue for my segment of this presentation, a severance payment. And so unfortunately, many companies are considering or have already started the layoff process related to COVID-19. And so we mentioned here some things to consider, nothing earth-shattering here, but does the company make severance? They got to cut off their benefits. They got to make sure that the employee gets COBRA, unemployment benefits, and liability releases for whatever severance payment they make are all part of the standard package and considerations that companies think about. But in this situation where there's going to be mass layoffs, we just want to remind people there are federal and state WARN acts. So depending on the state you're in, WARN is the Worker Adjustment and Retraining Notification, which is kind of a nondescript title. The gist of these laws is that when a company has a plant closing or a mass layoff, they have to give a notice period, and usually it's 60 days notice to employees, or 60 days notice when they're paying them for the next 60 days that this mass layoff is coming, so they have a chance to get a new job. And there are triggers as to when this WARN notice is kicked in. New Jersey recently, in January of this year, amended its statute, so I'll use that as an example. I realize that we have clients around the country now. Not everyone's in New Jersey, so but New Jersey is an example. They modified it in January. It doesn't kick in the changes till I think sometime during the summer, I think, is when they kick in. But which may cause people to alter their behavior from now until then. But what the New Jersey did was they made it even more favorable for employees. They expanded the notice period from 60 days to 60 days, and New Jersey is now the first state in the country which has a mandatory severance requirement. So in addition to giving notice, it has to give severance. It is a mandated minimum amount of severance, and this is probably going to be a trend for other states. So just look for the local. There's a federal law on point, a WARN Act, and there's also states. The states are likely to follow that New Jersey lead and make things more favorable for the employees. So just something the employer needs to consider when deciding and considering layoffs, and want to make sure they do the proper thing and follow all appropriate laws to avoid liability on the side of the employer. So with that, I will flip the next slide, turn it over to my colleague Jim Bartek, who's going to talk about some of the state and local tax benefits in conjunction with Barry Hartwitz. Jim?
Thank you, Dan. I'm sure you got hundreds of questions to answer, so get going on that. And after our session, we'll we'll turn it over to the team for some questions. As Dan mentioned, I'm Jim Bartek, a state and local tax partner at Withum in Whippany, and I'm here with Barry Horowitz. He's also a state and local tax partner at Withum in New York City, and also a SALT lead. And again, we're not here together. Everybody's social distancing, so Barry's at his own location. Now, please send questions as we're speaking, and we'll answer some at the end of this session. The immediate concern that we're going to talk about today is companies. For companies is getting and retaining cash. So Barry and I are going to focus the next 15 to 20 minutes on state and local tax issues that are affecting companies' cash. Please note Frank touched on the loan programs earlier in the session, including the New Jersey EDA. There's also other state programs, as Dan had mentioned, such as paid leave and so forth, and WARN Act and so forth. We will not be covering them. We're just going to touch on the tax issues during this session. If you do have questions about them, feel free to email us, and we'll certainly point you in the right direction and try to get you some help. Now, we're going to go through this quickly so we can get to the many questions asked during the first two segments. Now, to help companies, we do need to know how state governments and tax departments are rapidly responding to the COVID-19 crisis. If you've worked with state and local taxes before, you know that they've always been complex and caused a lot of anxiety since every state has different rules and deadlines. And although business operations have been disrupted, we still have to think about tax compliance issues. That being said, many states are making some temporary changes to help alleviate the immediate cash crunch for the taxpayers. However, many states, including New Jersey, are struggling over how to balance their budgets in this crisis while still providing immediate relief. Therefore, we need to pay close attention to which state and local governments are extending filing deadlines resulting from the crisis, and we've been helping clients preserve cash. And Barry will briefly discuss on the income tax side how many states are delaying filing and/or payments. But keep in mind, for some businesses, sales tax could be one of the largest taxes they pay. While more states have addressed the income tax delays, there are also delays on the sales tax filing and payment due dates, and I'll show you where you can go to find some of those delays. Now, for sales tax purposes, also the economic nexus rules resulting from the Wayfair case in 2018 have made it quite difficult for the small businesses to comply with those sales tax changes. Now, the remote sellers, they have to pay close attention to all changes from all the states, as well as the localities, which are coming in at a frequent pace. Now, I want to remind you that delay in filing or payment may help immediately to preserve cash today, and especially since some companies might have trouble collecting from the customers due to, and of course, hopefully this is not the case, but it becomes a bad debt. But they certainly, if they delay the payment of those, they won't have to file a refund as well. So, however, it doesn't mean companies get to keep the dollars they collect, because sales tax is a trust tax. Jess, can you go back to the map? Thank you. Now, as you're aware, each state has its own laws and regulations, which complicates matters. I mentioned that before. You can imagine monitoring all the states' updates and guidance. It's been quite a task. So in order for us to provide guidance to our clients, as well as our internal Withum partners and tax teams, our state and local team created the map that you see on the screen and placed it on our the Withum COVID-19 Resource Center. And this, if you can see at the bottom, there is a link to that site. It's not only state and local taxes, of course, there's all kinds of information such as Dan's and Frank's articles. But this particular map, the way you would use this map is if you're looking for a state, this particular map happens to be income tax, you would click on one of the black dots, and that would bring you to the update for the states. Now, we do update that quite a bit. If we hear of an update, we update it immediately. The next page. So also on the web page, again, I'd mentioned some articles. We have a separate item here for sales tax updates due to coronavirus, and again, you'll see that in the upper left on here. That there is a map on there as well, which takes you to the particular updates per state. And again, it is updated quite a bit. And then we also have, as Frank had mentioned, some of the state economic development grants. That is being updated regularly as well as new states come out with new programs. There's also an article on payroll and employment tax, as well as some other items. Dan mentioned the Warren Act. There's for New Jersey, there's an update on that as well. And again, these are updated constantly. Next page. Now, companies should note, basically all state taxes are affected. It's not only income tax, sales tax, of course, corporation or franchise taxes, gross receipts type taxes, payroll taxes, property taxes, transfer taxes, excise, and so forth. Now, again, Barry's going to touch mostly on the income and sales tax, and then we will discuss some issues we've been addressing for clients regarding the payroll and employment tax issues. And we'll discuss some issues we've been handling quite a bit, is audits, notices, as well as touch on some potential opportunities we may want to look at now for our clients. Barry? Do we have Barry? Guess we lost Barry. Okay, so do you want to go to the next slide? And when Barry jumps back on, we'll let him talk. He might be on mute. So as I mentioned, many of the states have given us guidance on potential income tax as well as sales tax. We're just going to touch on some for some of these states right now. For example, in California, again, there's some states that have touched and given guidance both on the personal income tax as well as the corporation income tax as well. And California happens to be one that's given guidance on both. Okay. And on the sales tax side, some states have given guidance on extensions. And here you can see California has extended the due date. Now, what they've done in California is they actually gave an extension on the due date for the first quarter. And this is for business taxpayers below the $1 million threshold. Now,
Jim, am I on?
Yeah, you're
Jim?
on.
Finally, thank you. Okay, I can jump in a little bit. Good afternoon, everyone. As Jim, and I apologize, Jim. As I mentioned, I am calling you from Monmouth County, New Jersey, about 50 miles south of Jim. And we put a lot of slides in with various states showing the extensions. Almost every state in the country now, and a lot of localities have now extended the due dates of the tax returns. Most are going out to July 15th. Payments are extended out, estimated payments are extended out. So again, each state has jumped on the bandwagon trying to piggyback and follow the federal tax rules. And again, as Jim mentioned, we have two types of taxes here. We have the income tax, obviously, which is a personal income tax. We have corporate taxes that we're dealing with, and obviously sales tax. As Jim mentioned before, it is quite important that on the sales tax side, it is a trust tax, that it is remitted. If it's collected, the states are not stopping with that. Some states are coming up with creative ways to do that, and I will jump in and go over there. Next slide. And again, you can see here, we have a lot of different states and jurisdictions, District of Columbia. Jess, move on to get to Illinois. Okay, so just to give you an example, and we've seen it in other states coming out in the last couple of days. Again, just getting back to the beginning, I apologize for some technical difficulties here on my computer. This is being updated on a constant basis, and as you work with clients and clients themselves on here, we have to continue to monitor what the states are doing. The states are looking every day. Obviously, the states are broke. Revenue has dried up. They're waiting for revenue from the internal revenues from the U.S. government to come down. So obviously, the states are trying to find creative ways to receive payments. So, for instance, Illinois has come out where you can pay out your sales tax in installments over a 4-month period of previously collected money. So again, states are thinking of creative ways in order to get revenue into their coffers. The states are obviously paying out enormous amounts of money for hospitals and social services in this crisis, which hopefully we all get through this safely and we can return to some normalcy sometime later in 2020. Next slide. Okay, Maryland, same thing, July 15th. If you look on some states, they've actually gone to the July 15th due date. Some states have not increased the corporate due date yet. A lot of them were doing May 1st and beyond. As we get longer and longer into this crisis, Dan had mentioned before, that it keeps on dragging out, obviously. The states will probably enact additional due dates for all the corporation returns. Next. Massachusetts, same thing. Massachusetts come up with things about late filing, late payments. And again, as we go throughout the country, we're just trying to show that various states have come up with significant changes in their collection system. All right, I guess we can hit New Jersey and New York now. So let's get to New Jersey. New Jersey. Many of you may be based in New Jersey like I am and Jim is, although I work in the New York City office of Withum. I'm all over the place, and I lived in New Jersey for 36 years, so I'm a New Jersey resident. New Jersey was one of the last states to enact an extension on both the personal and the corporate side. New Jersey has done something which is historical. They've actually changed the budget date of the year end of the state of New Jersey. It was originally June 30th, which was holding up New Jersey enacting these new rules. It has now been extended to September 30th, is now the new fiscal year end of the New Jersey budget. So New Jersey has a 15-month accounting period for this year. We couldn't do that if we were in business, but the state can make a change in its law, and it's done that. This was done all for budgetary reasons, and that's why New Jersey's being held up. Jim and I have been in contact with John Vacara and other officials from the state of New Jersey on a constant basis on conference calls last weekend, and we were imploring them to extend the due date, which they finally did. We're waiting for additional guidance regarding estimated tax payments. And one of the things that I will mention, Jim and I will get that later in the planning, is, right now, all of us are in a quandary what to do for 2020 estimated tax payments. The federal government is obviously due after the first quarter is due after the second quarter, which is due June 15th, and the first quarter due July 15th. At this point, who knows? I mean, all of us may want to conserve cash, as Jim said before. Cash is the king right now, and we may want to see how this plays out. Many of us will show losses. Businesses and everybody else's individual and corporate, income tax situations for 2020 will be quite different. We may hold off paying estimates. So again, we're waiting for guidance from New Jersey, and hopefully we'll get it. But again, we have to do planning for everybody as we look along at the economic situation of the entire country. So again, New Jersey, come there. Again, revised due dates, still original due dates for sales tax. If you've collected it, they want it remitted. Next slide. New York State, again, another state that took a while to get it. It came through an executive order through the governor. Again, delaying everything to July 15th, and both on the personal and corporate side. Obviously, both the state of New Jersey and New York State are epicenters of this deadly virus, and certainly the governors have been dealing with the health crisis. They get into the economics after. Obviously, they're going to have to deal with the economics because they have to run their states, obviously. New York State, again, now delaying out late filing and payment penalties for sales tax. However, the big retailers and the big companies that had prompt tax, that is not being delayed. Obviously, we believe now prompt tax will slow down unless you have an internet company that has huge sales tax collection in New York. Prompt tax payment will slow down, but prompt tax, which is for large retailers, does not have that exemption, and you must file that timely, and there are onerous penalties when it's dealing with prompt tax. Next. So again, New York City is another jurisdiction that we've been working with. I've been dealing with the commissioners on New York City. New York City has put in a waiver of penalties. They still are requesting that extensions be filed on April 15th for C corporations that may be due, individual UBT returns that may have taxes. They are requesting extensions in payments due. There are a waiver of penalties. There is not a waiver of interest. New York City, of any jurisdiction, is probably broke more than anybody else right now, and they have no revenue at all. They wait for the state to give them revenue and the federal government, and obviously tax revenue is coming in. Property taxes for New York City are not being delayed right now. They are there. New York City will be favorable in dealing with taxpayers with the penalties. You have to send a letter up, which I just actually got a draft of the letter about 20 minutes ago, sent to me, of what they're recommending be filed. But again, New York City has not extended out the due date for UBT and for C corporations right now. So again, we are recommending with them and to clients that we follow these extensions and get it in. Whether there's payments to be made or not is another issue, but at least get the extensions in. And we'll finish up the slides. We have Pennsylvania, I believe, and let's go to the last slide there. I think it is. And now, okay. So some of the big issues, and Jim will jump back and forth with me on this, is the payroll employment taxes. One of the big things that is happening, all of us are working remotely. I'm sitting in, like I said, in Monmouth County. Jim's up in Bergen County. Dan's in another county, and Frank is down in Ocean County. So we're all over the place working. And the remote workplace has now become the mode of basically everybody in the United States. The states, this could come up as an issue. New York State has the convenience of the employer rule, which says that depending upon where you work, if you work at home, that money that wage income reverts back to the home state. New Jersey, and I just saw Mississippi have come out. New Jersey was the leader in this. New Jersey specifically said, if you're working at home, but based out of New York, let's say, or based out of Pennsylvania, we are not going to go after the individual for taxes paid in the state because you're physically working here. It will revert back to the state that you are based out of. On the contra side also is that the corporation or entity that you're working for will not have nexus in the state because of this situation. New Jersey is being very liberal. We're hoping other states will follow the lead of New Jersey and follow along and do the same thing. One of the main things that I will talk about, and then Jim jump in after that, is unemployment insurance. If you have people who will be laid off, or you will be laid off yourself, you must check with your employer to make sure you file for unemployment tax in the correct state. Okay, so if I'm working in New Jersey, got laid off, but I'm based out of New York, the employer is paying taxes to New York State unemployment insurance. That is where you have to file. If you fall in the state that you believe that you live in, and working remotely now and get laid off, the state will reject it and automatically reach out to the company and ask them why they have not filed unemployment taxes. Jim, why don't you jump on to the next pieces?
Yeah, and sure. And I think just to add on to what Barry was saying, of course, is what we suggest is monitor the guidance from the states. Again, New York during Sandy took a position there was an exemption from this inconvenience of employer rule. So there was an exception to it, but otherwise they're going to follow that. So just keep your eye out for guidance from the states. Also, one other point is Dan had mentioned Code Section 139 on the federal side. Some states have explicitly excluded this income for disaster recovery payments, such as New Jersey had put out a memo on this at one point, but other states have been silent on it. They haven't really mentioned that. So it's just something to keep in mind when you're thinking about what's going to be includable for income for your employees at the state level as well. And then the last thing was Nexus as well, as state of New Jersey basically said they're not going to hold this as the company's accountable and saying that this creates nexus. And again, New Jersey has come out and said that. So again, just wanted to point those out. So next slide, please. So let's talk about the audits. Auditors have been asked to work at home as well, just like most of us. So many will adapt and look to continue the audit. On the other hand, I've had several auditors from New Jersey in particular that have delayed, basically said, let's wait to see when we can meet in person. So maybe that will change. Hopefully we will be back working soon at the offices, but if not, then again, I would just say keep open communications with your auditors. They should understand if there's some complications due to the emergency. We have been conducting virtual meetings with other auditors and calls. We're sharing screens, but bottom line is make sure you're keeping in touch with the auditor.
And Jim, just to mention, we've closed out 5 audits in the last week with New York State and New Jersey. We closed out a $2.5 million case yesterday. So again, states are looking for money. They're willing to work with us. There's open lines of communications. All the supervisors and heads of the units are available to talk. So again, it's an opportunity to probably settle up stuff and get a lot of things from the back years away. Yeah, absolutely. Could be a good opportunity to expedite the review if that's what you want to do. I have sensed a bit of understanding from the auditors, and as Barry had mentioned, some of the states do want to have the money, so there's good opportunities to actually settle up. Now, of course, there could be scenarios where sales or expense invoices or
exempt certificates may be tough to get, especially if it's hard copy or if your IT department can't give you access for some reason. Again, they should be understanding on that. But we're being creative, looking for alternative methods to condense the scope of the audit, again, expedite it. Now, go on.
Jim, I just want to mention, and just for everybody's edification, the IRS has basically shut down their taxpayer services. But so audits are going to be happening or whatever else, the same thing with the IRS. If there's anything out there, make sure that it's timely returned to the IRS. You show your proof that it's sent in to make sure when the IRS gets going again, that we have met our statutory. Some jurisdictions are extending right now. The statute, I know New Jersey actually extended the dates on theirs, but again, it's something out there. I apologize, Jim. Go.
Yep, no problem. Now, again, we're being evaluating whether to keep waivers up to date and open. Again, you're going to get some notices from the auditors asking you to extend that. That could be your benefit if you're looking to preserve cash and don't want to pay right now, or if you have a refund opportunity, it could be a benefit to extend. So just weigh that as well. We did mention settlements as far as negotiating installment payments. Again, some of the states want the money now. They're more than happy to entertain some installment payments if you're having trouble with cash. Now, notices, also very important. Make sure you're responding to the notices. They don't go away. Sometimes they are sent. Hopefully you have somebody in the office letting you know, because a lot of times those are sent via mail directly. Okay. Now, next page.
Okay. So now we talk about the income tax law, which I mentioned before. It's going to be a very important time now to review what 2020 looks like for all companies, including Withum, to see what's going on this year. Obviously, operations. Again, clients may want to, and clients and companies may just want to hold off making estimated payments to see how everything rolls out here. We anticipate everybody's revenue and most companies' profits and losses will be down. So it's basically effective cash flow here, or you make minimal tax payments that you might want to make in here. One of the things that we are looking at, it may be a perfect time for refund opportunities. As Dan had mentioned previously, the IRS, Congress passed a carryback rules. The former rules with the TCJA was everything was carried forward. Now there's a 5-year carryback claim. A lot of states don't allow carryback claims. We are monitoring and watching to see if states will mirror the Internal Revenue Service to have the carryback claims here. So again, it's very important to look at certain credit reviews, look at whether it's better if the fall combined as, a unitary on a group may have refund claims, look at apportionments to make sure we're allocating correctly. And again, there might be positions take for refunds right now, file it, put it through the system, and very well we could win on appeal or whatever else. So again, it's very important now as we look at potential refunds that we review everything out there. Jim?
On the sales tax side, many states have extended payments of sales and use and other taxes. However, in the future, we do expect that since profits will most likely be down this year, states will focus more heavily on wayfare for not only sales tax nexus, but income tax nexus as well, potentially, especially with the gross receipts type taxes. Now, states will be looking to meet budgets once the crisis ends. Therefore, it's always a good time to review purchases for refund opportunities on the sales tax side. And sales tax laws are complex since sales tax is generally a tax passed through to customers. Companies generally attempt to be conservative when collecting the tax. So they're charging tax on potential non-taxable sales, especially if it's a gray area. Now, especially after Wayfair, think of all the smaller companies making tax decisions without an expert on their staff. So the company could be paying sales tax to vendors without realizing there is an exemption available. Now, also on the tangible personal property might be some revaluation of tangible personal property or even real property for now. Now, on the other hand, we do go on.
No, finish up, Jim. I'm sorry.
Yeah, I was just going to say, on the other hand, we do expect states to be creative on how to keep jobs in state, including retention incentives, re-examining existing incentive agreements, and other programs. So we do expect companies to be aggressive in attempting to retain or attract new businesses as well in the future. Barry? Right.
And it's very important now with the state programs out there. If clients were in voluntary disclosure programs, we want to continue those programs, have an open line of communications with the departments. If you believe you may have to file in a state voluntary disclosure, what should be looked at right now. We believe some states may come up with amnesty programs. New Jersey had a once in a lifetime 4 amnesties. We could see that again happening down the road, that states may put in amnesty programs. And finally, installment agreements. I settled a tax examination with New York State. The client does not have all the money to pay it. I told the auditor right up front, the supervisor, we're going to pay $5,000 down payment. We're going to start to make payments every month. They're looking for the money. They'll get it. They'll work with penalty abatement, but we're showing good faith here that we're trying to remit money here. There's many potential opportunities here at Withum. We will work with you. We'll advise and hopefully get back some money, well-needed money for everybody. With that, Jim, I think we're done with the state and local side.
Yep, let's go to questions.
Thank you
Allison?
very much, everyone.
Yeah, do we want to kick it off with Frank's questions that were coming in?
Sure. Thank you, everybody. Frank Bourdelette back. So yeah, I had a lot of questions here, and we sat all night with a bunch of questions ourselves. So first thing I'll say is the EIDL is the Economic Injury Disaster Loan. That's a loan, but they will give you a $10,000 grant when you apply. Then you follow through on the process to get the actual loan, which is up to $2 million. That's done all through the SBA. The SBA determines. We do not know why they are asking for cost of goods sold. And some comments where I don't have cost of goods sold. So you put 0 in that box. The PPP loan, the Paycheck Protection Program loan, does not include 1099 people. It specifically came out last night. That was a big question. A lot of people were looking at it both ways. It does not. So one more time, does not include 1099 people. They can file for their own loan. It covers 2.5 times the average monthly payroll costs for 12 months before the application. We don't know. The instructions say some companies may use 2019. We don't know why it says it in the instructions when the law is different, but that is what it's saying. Some of the bank applications will be April 1st, 19 to March 31st, 2020. So again, check with your bank. And speaking of banks, we had a lot of comments. Bank of America said, if you do not have an account with us, if you do not have a loan with us, we are not accepting you. Again, that goes to know your client. So there's a lot of background information that they need to get. And I think the banks are struggling with this alone. And then to do all of the background checks on every business that comes to them would take much too long to get the loan processed. Some banks are saying on their website, sorry, we're not sure yet. We're waiting to the final rule to come out before we process anything. So they're on hold. So while the SBA is saying you're open for business today, it may not be. Not-for-profits, 501c3s can apply for the Paycheck Protection Program loan. But 501c6s does not seem like they can. But those 501cs and 501ds can apply for the EIDL loan. So you can go over there and apply for that. Self-employed individual, or I'm staying at home. So basically, for the forgiveness piece, you are getting some money and then you have 8 weeks to pay it out, but you're not able to open because you're a restaurant and you're shut down. You can still pay your employees. The purpose of this is to get money into the hands of the employees. So even though you don't open your shop, you can still pay your employees. If you are self-employed and you applied for the loan, we believe since you're not open, you'll probably get that whole loan amount forgiven because you're not open. So that's our belief right now. That could change. As Dan said earlier, everything's subject to change. In fact, on the forgiveness piece in the actual document, it says that this was the rule that came out last night. The SBA will issue additional guidance on loan forgiveness. So even as of last night, they're not sure. Because again, that's going to be 8 weeks after you get the loan. It could take a month before you get the loan. It could take 2 weeks. We're not sure. Let's see some other questions. Okay, the certification that you're going to sign. It says current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. I am not an attorney. I don't know how to interpret that. I'm an accountant. So you have to determine, is it necessary to meet your ongoing obligations and you need this loan? That's something that I can't answer for you. You have a profit last year of 3 million. This year it's only 2 million. Do you have trouble meeting your obligations? Don't know. The banks, I believe, are going to review these loan documents. Like I said, we had one of our clients apply or talk to the bank about applying, and the bank said, "I think you're going to get denied. You had a profit. We don't think you need the money." So I don't know what's going to happen with those type of issues that come up, but some more.
Frank, this is Dan. Can you hear me?
Yeah, yes.
The interesting question came up on that, and then in that document that came out yesterday, the interim final rules. One of the things they allow the lender to do is to rely on the borrower certifications, and they don't seem to have to do diligence behind that rep that the borrower makes that the loan is necessary to support their operations. So it's not clear to the extent that banks are going to want to do diligence and feel they have to, but they're not. They don't seem to be required to under that document.
Right, and that's why the banks are denying applications from non-clients that are with that bank, because they want to know their client, so they want to understand, because they have access to all of your records. If you're banking with them, they see all of your checks coming through the bank and your deposits. So that'll be something that they're going to look at. Another question: if you're foreign owned, and your parent is in another country and the operations are here in the U.S., you would use all of the employees to determine if you're under 500 for the entire affiliated group. But U.S. companies can apply for this money if they feel that they had some economic impairment. But you look at all of the employees. So the affiliation rules, as I said before, are changing. They'll probably change tonight, is what we're expecting. So let's see. I'm trying to think. I had a few more here. I think I hit on the ones that are most. Why don't you guys take some more questions if you want, and I'll jump back in later. I think
Sure,
I hit
I'll take some.
Typical.
I'm happy to take some. So I got some questions relating to the extension. The question was, would the July 15th payment cover the second quarter extension? The answer is no. That extension is due on 6/15. Another question was relating to Form 3520. The answer, that's not extended. There is a list of extended forms, and one of the IRS notices that I mentioned in that document lists every form series that's covered on the extension, and that's not one of them. But so it's listed there. So in one of my articles too, if you type in my name Withum extension, it'll come up, and I list all the series of forms in there. Two other questions came up regarding the sick pay provisions of the FFCRA, Families First Coronavirus Response Act, and the PPP. And so the answer is, if you take the sick pay and you make sick pay and take the credits from the government, that will not count for wages for the payroll costs for purposes of the PPP. There's a particular exclusion in there for sick pay. The second point, so you can't double dip the loan, which makes sense, right? If the government's paying the salary, they're not going to give you a loan based on that amount. So those are my questions. I'll turn it over to Jim. And then when he's done, we can go back to the PPP questions, which I see are dwarfing everything else because that's the hottest topic these days.
Right. Yeah. So one question was, how about amended sales tax returns and getting money back for refunds? Again, the sales tax return, the amended sales tax returns and refund claims, the statute is not going to be extended. I haven't seen that in any state. So make sure you get them in timely if you are going to be filing refund claims. Now, getting money back from refunds, we do expect states to dig in at least until the crunch is over, of course, to make sure that you have the proper information included with the refund claims. Barry, you want to take a question?
Yeah. Again, with the New York monthly filers, New York did come out delaying for smaller taxpayers regarding sales tax. There is going to be, I believe there's going to be some delays out there, but again, New Jersey waiting for more guidance. We're waiting for more guidance from them. Again, we mentioned prompt taxes due every month, those monthly. So again, waiting for full guidance. Real estate taxes are paid to the counties and the municipalities. My taxes due May 1st in Monmouth County. I have not seen anything showing that there's going to be a delay. They have to pay the local police and whatever else, so they have to continue with that. Okay, Jim?
Okay.
One of the other questions was when are CBT 100 estimated taxes due? Again, there hasn't been much guidance on that. We're waiting for that from the state. Barry, you have any other comments on that?
Back from state, and again, New Jersey has specifically said on their website, please check currently and keep on reviewing their websites for updates. They're updating constantly, and again, they're dealing with budgetary in New Jersey, and they're waiting to give out there. We've been in contact again with the officials, and we're coming along there. And I don't know, we have to look at the last question, Jim. If they're going to qualify for federal, I think they should be. I do believe they should be, but we'll have to see from there.
And the one point I did want to mention before I send it over to Frank again is California has come up with some guidance on giving certain businesses up to a year to remit the sales tax. So I think you'll see your certain states, looking for what other states are doing as well. So just keep an eye out for New York and New Jersey web pages, as well as Pennsylvania or Connecticut, just so you understand how they might provide guidance going forward. You can always call us as well. Frank, you have a couple more questions?
Yeah, I have a couple more. Thanks. So one question is, when is it a bad idea to apply for these assistance programs? Bad idea is if you don't need the money. And again, you're signing a certification that you have uncertainty makes this loan request necessary. So if you can't honestly sign that off, then it's a bad idea. How many hours are required for an employee to be considered full-time? We believe the SBA seems to indicate it's 30 hours. So any 30 hours is considered one FTE. So when you're calculating the number of employees to apply for the loan in the first place, the 500 counts a part-time person as an equivalent to a full-time person. So just number of people. Whereas when you're calculating the FTEs for the amount of, look back to see if you kept the same number of FTEs in for the forgiveness piece when you're reducing the forgiveness amount, an FTE would be 30. So if you have 2 part-timers at 15 each, that would equal 1 full-time equivalent. Now we're getting a lot of questions here on this next one, and I can't avoid answering it, I guess, is what it goes into the payroll cost. Dan, you can jump in anytime and save me. So right now, the issue is that we've been back and forth on this. We thought this rule would come out and clarify it, and it seems to make it just as muddy as it was before. The question is, do I include federal withholding on the employee and the employee's portion of FICA? And the answer is, don't know. We're internally still mulling that over. We believe that that doesn't make sense to do that because the employer would not have the monies then to pay the employee in full. So we're not exactly sure how we're going to handle that going forward. I have seen some other accounting firms say that they're going to exclude the federal withholding and Social Security tax on that amount.
Yeah, we know we're pretty sure you don't. We're certain you don't add it to the employment amount. The question is, do you deduct it or do you not? Do you just not increase it? And that's where the debate is. And we've seen some very reputable payroll companies say that you do not exclude it, and we've seen some people say you do exclude it.
Right, because in certain aspects of the law, when you're reading it, and I'm not an attorney, in fact, I'm an auditor, so I read FASBs. But in reading this, there's certain sections that say subtract this amount. And there's other sections that say exclude this amount. So I'm not sure what that means when you exclude. It's like I never included it in the first place, so I don't have to include it. So when I see exclude, I'm thinking of when the employer goes to pay the amount. The other item is health insurance and 401k